Good afternoon and welcome to everyone on the webcast, those dialing in via the telephone lines and via LinkedIn. Today we are sharing the Nedbank Group's interim results to 30 June 2022, which we believe demonstrate that Nedbank has done well to navigate what is still a complex and challenging external environment and deliver a strong set of interim results. The format of today's presentation, as shown on the left, will start with my reflection of the highlights of our results, as well as the operating environment, and then I will reflect on the progress we have made on our three strategic growth drivers, before handing over to Mfundo Nkuhlu, our Chief Operating Officer, who will update you on the very important technology program to build a modern, agile and digital IT stack, which investors will know we call the Managed Evolution, as well as our 5 strategic value unlocks. Mike Davis, our Chief Financial Officer, will follow Mfundo with a detailed analysis of the Group's financial performance in H1 2022, including the performance of our frontline clusters. I will come back at the close to review the outlook for the remainder of 2022, the progress we have made toward our medium targets through to 2023, and make some concluding remarks. Similar to prior interim reporting periods, our frontline managing executives will not be presenting in person today, but are available for Q&A and will be part of the usual investor meetings over the next week or so, and will be back part of our 2022 year-end results presentation to provide more in-depth cluster feedback. You will also notice some slides in the booklet are marked booklet slide in the top right-hand corner. These are slides of additional information for investors, and we will not speak directly to these today. Starting then with the overview. H1 was a period of 2 very different quarters in the external operating environment. Q1 was generally a supportive economic environment for banks, and GDP grew strongly by 1.9% quarter on quarter. However, in Q2, the economic environment became more challenging, as the impacts of Russia's war in the Ukraine impacted on inflation and interest rates, and closer to home, KwaZulu-Natal experienced flooding and load shedding escalated to very high levels. As a result of all of these, we currently expect GDP in Q2 to have contracted by 1.2%. Corporate lending activity was generally slow, but improved towards the end of the second quarter, and, along with attractive pipelines, position our wholesale business for improved activity in the second half of the year. On the retail side, clients have remained resilient to date, despite rising interest rates and higher levels of inflation, although we have seen early signs of pressure emerging in some segments. From a strategy perspective, delivery remains on track. We continue to see the benefits of digitization delivered through what is known as our Managed Evolution IT Build program, and this is driving continued improvements in efficiencies, as well as client experiences, main bank client gains, and importantly, household transactional deposits, where our market share increased slightly during the first 5 months of the year. We have also maintained our focus on leading in all matters to do with ESG. Operational metrics improved further in the first 6 months of the year and were also better than we had expected, evident in pre-provisioning operating profit growth of 17%, a positive jaws ratio, and as a result, the cost-to-income ratio that declined to 56.2%. Financially, revenue uplift of 11%, good expense control, and a flat credit loss ratio drove headline earnings growth of 27%, and along with a very strong outcome on key balance sheet metrics, enabled 81% growth in the interim dividend, pleasingly now back above H1 2019 or pre-COVID interim dividend levels. Reflecting on the external operating environment in a little more detail. From a global macroeconomic perspective, the environment has been challenging, impacted by Russia's invasion of the Ukraine, the hard lockdowns in China, resulting in supply chain constraints, elevated commodity prices, which were initially beneficial to South Africa's terms of trade, but have since started to wane, rising inflationary pressures, particularly energy and food prices, and as a result, monetary policy tightening ahead of expectations. In recent times, fears of recession in both advanced and developing countries have increased, whether you use the traditional definition or not. In this global environment, you can see from the graphs that the South African economy has to date been relatively resilient when compared to a number of global and other key emerging market peer countries. South Africa's Q1 GDP growth was relatively strong, as shown in the first graph. Inflation has increased, but not to the same extent as seen in many other markets. Interest rates have increased 175 basis points year to date, and the rand has performed well against the strong US dollar, particularly on a relative emerging market basis. From a corporate client perspective, business confidence level remained weak at below 50, but we have seen some green shoots as private sector fixed investment edged up off a low base, and wholesale client activity in our own business increased in the latter part of Q2, driving a mild recovery in loan growth. Albeit our view that the pace of structural economic reform in South Africa remains far too slow, there have been some encouraging developments on key reforms, as shown on the right of this slide. Some of them you will recognize from our previous presentations, but the most important change to this list is the recent announcement of the South African government's Energy Action Plan, with a long overdue set of strategic actions to address the ongoing electricity constraints, including improving Eskom's own operations and adding significant new capacity to the grid. Urgent implementation, unfortunately something that historically we have not been good at, of this action plan is needed to ensure a sustainable and affordable electricity supply, which is key for unlocking investment, faster economic growth and job creation over the medium to longer term. On the negative side, in the second quarter, economic activity was disrupted by the floods in KwaZulu-Natal and a return to severe electricity load shedding, with our economist expecting load shedding to remain at elevated levels in 2022 and still to be around for the next few years until sufficient new generation is actually connected to the grid. From a retail client point of view, households have to date remained resilient in the face of rising inflation and interest rates, but we do expect some pressure to emerge, particularly in lower LSM levels where inflation impacts are highest. However, as you can see on the graphs, since the global financial crisis, households have delevered, with the debt to disposable income ratio at a relatively low 64.5% and households' debt servicing around a 16-year low, supporting reasonable demand for credit in both home loans and vehicle finance. Importantly, looking at the graph on the bottom left, households in the middle and upper income segments have accumulated savings during COVID-19, providing some buffer against rising interest rates, although this is slowly depleting. However, there are some early signs of increasing pressure on some consumer segments, particularly the entry level, from increases in transport costs, electricity, and food prices. Our current view is that this inflation shock is not likely to be as severe as during the global financial crisis, but forecasting inflation in the current environment has proven difficult for central bankers and economists, and we are monitoring this carefully. Turning now to our strategy and resultant financial targets that we announced as part of our financial results in March last year. This is also a slide investors will be familiar with and is designed as a framework to orient key elements of our strategy and our resultant financial targets on one page. We have identified 3 strategic value drivers as shown at the top of the slide, being growth, productivity, and risk and capital management. And we believe that delivering on these will enable us to reach our financial targets that you see at the bottom of the slide. I will unpack progress on each of these shortly. Underpinning delivery of these three are 5 strategic value unlocks, or more detailed programs of action, all enabled by our Managed Evolution IT strategy. And these you can see in the middle of the slide. Mfundo Nkuhlu will cover our progress on these in more detail. I am now going to conclude my introductory section by talking to 3 slides, showing our good progress on the 3 strategic value drivers of growth, productivity, and risk and capital management, respectively. So starting with growth. The graph shows how trends across NII, NIR, and advances growth have improved from the COVID-19 pandemic lows, supported by strong digital and client-driven growth. In H1, CIB recorded 11 primary client wins. RBB grew main bank clients 2% year-on-year, and Nedbank Africa regions grew their client base by 4%. All digital metrics continued to grow very strongly, with app volumes, the key retail channel, up 35% year-on-year. Net interest income grew 9% and benefited from higher interest rates and advances growth that picked up to 7%, with CIB growing more strongly toward the end of the second quarter and RBB continuing its momentum from the prior year. Non-interest revenue, excluding the macro fair value hedge accounting debits in the base, grew 7% as transactional activity increased, offset by weaker trading activity, particularly in debt securities. From a productivity perspective, we have seen the outcomes of our optimization efforts becoming more evident. Our cost-to-income ratio declined to 56.2%, on our way to our medium and long-term targets of 54% and 50% respectively, while pre-provisioning operating profit growth was very strong, increasing by 17%. The productivity improvements have in large part been driven by the emerging benefits from our Managed Evolution IT build that is nearing completion, and which has enabled increased client use of our more cost-effective digital channels, as well as ongoing process improvements, alongside headcount reduction, mostly through natural attrition, and real estate optimization, amongst others, contributing to 1.2 billion rand of TOM2 savings to date, slightly ahead of the targets we set ourselves. Lastly, our risk and capital management metrics are robust, having all improved to materially above 2019 levels. Starting at the top left of the slide. Given our strong financial performance and a slight reduction in risk-weighted assets, our CET1 ratio at 13.5% ended the period materially higher than pre-crisis levels and also well above the 12% top end of our board target range. Mike Davis will reflect on this strong capital position as well as our approach to capital allocation and capital management in his slides. Moving to the bottom left, liquidity metrics such as liquidity coverage ratio and net stable funding ratios are strong and are also higher than pre-crisis levels. On the top right, these robust capital and liquidity outcomes supported a strong interim dividend of 783 cents per share, declared at the bottom of our 1.75 to 2.25 target cover range and up 81% on the 2021 interim dividend, as I said earlier. On the bottom right, from a credit point of view, our credit loss ratio was flat and within our through-the-cycle target range, while overall impairment coverage remained high at 3.31%, highlighting ongoing prudency in balance sheet provisioning in uncertain times. I will now hand over to Mfundo Nkuhlu, our Chief Operating Officer, to talk to the progress on our strategic value unlocks.
Thank you, Mike. Good afternoon, everyone. I'm pleased to report that the delivery on the group's strategic value unlocks is progressing well and is delivering financial benefits as noted by Mike. Commendable as the progress is, we still have more work ahead of us to unlock further value in the medium to longer term. In my section today, I will cover the group's 5 strategic value unlocks. I will start with an update on the progress we have made on our managed evolution technology strategy, and will then deal with each of the strategic value unlocks in more detail. The IT build of our managed evolution technology strategy is nearing completion and delivering benefits as per plan. Investors will be familiar with this slide from previous presentations. Most foundational IT programs are either complete or nearing completion, with only around 1.3 billion rand of spend remaining. The final IT components to be delivered over the next 2 years include the refactoring of core banking components, such as deposit and transactional products, some outstanding onboarding and servicing components, and the final phase of payment modernization. As shown in the graph on the right, to date we have completed 89% of our IT cash flow spend and realized 51% of our planned run rate benefits. The rationalization and simplification of our core banking systems have resulted in a reduction from 250 large systems down to 76, and this is enabling lower costs in infrastructure, support and maintenance, less complexity, and increased agility in adopting new innovations. Importantly, as shown on the right-hand side of the slide, levels of IT cash flow spend continue to reduce after having peaked in 2017, and as a result, the group's intangible software assets peaked in 2021 at around 9 billion rand, with little risk of material overspend remaining in the program. Key benefits of the Managed Evolution Technology Strategy are the world-class digital capabilities, products and channels we created for our clients. Digital uptake and usage continue to accelerate, as evident in multiple metrics on this slide. Digitally active clients increased further as percentage of both active clients and main banked clients to 37% and 67% respectively. Sales of products through our digital channels increased from 12% in 2019 to 50% in the current reporting period. Digital transactional volumes and values have increased by 78% and 39% respectively since H1 2019. And the trend towards usage of Nedbank banking apps is even more pronounced, with a 167% increase in active app users and an almost 3 times increase in app volumes and values transacted. In addition to our traditional digital products and solutions, we have also been innovating in the platform or ecosystem space in the form of ongoing disruptive market activities, this being our second strategic value unlock. Over the past 2 years, we have highlighted to investors some of our platform and beyond banking initiatives built off the Managed Evolution IT foundations. Some of these are shown in the middle of the circle, including Avo, our super app. In respect of Avo, starting on the left, since its launch 2 years ago, Avo has signed up more than 1.5 million users, up 4.6 times year on year, along with over 24,000 businesses that have registered and are offering their products and services on this e-commerce platform, up 37% year on year. From an operational perspective, Avo has access to over 10,000 drivers in its delivery fleet nationwide, as product orders continue to grow exponentially, as seen in a 9-fold increase in gross merchandise value. Avo Auto, our virtual vehicle mall, now hosts over 140 MFC accredited dealers with more than 6,000 vehicles available on the platform. In April, we launched Avo B2B Marketplace, making it easier for business buyers and sellers to connect anywhere, anytime on a secure platform, and in Q2 of 2022, we were appointed an official Apple authorized reseller. The efficiency benefits from our managed evolution IT investments and digitization are also evident in our target operating model program. TOM 2.0, which was launched in 2021, is aimed at optimizing the shape of our physical infrastructure in a more digital world, shifting our RBB organizational structure so that it is more client-centered and optimizing our shared services functions across the group, all as a result of the digital benefits from managed evolution. In H1 2022, additional TOM 2 cost benefits of 229 million rand were unlocked, bringing the cumulative number to 1.2 billion rand on our way to a target of 2.5 billion rand by end 2023. The benefits of our TOM program are evident in improvements in key operational metrics, as we show on the right-hand side of this slide. As more products and processes are digitized and customer behavior changes, we've been able to reduce headcount by 10% over the past few years, largely through natural attrition, while branch numbers shrunk by 8% without impacting client experience. Commercial real estate is also reducing, both the square meterage in our branches and that of our own office space. Turning our focus to growing in attractive areas for value creation, or strategic portfolio tilt 2.0, here outcomes have been mixed in H1, with our overall aim to target profitable market share gains over time and increase cross-sell, while being prudent in a more difficult environment. In wholesale lending, we continue to focus on the right clients, sectors and products to optimize capital and returns. We have seen growth in client activity towards the end of Q2 and expect an increase in pipeline conversion in the second half of the year. We've also been selective in areas where we have strong market share, such as commercial property finance and vehicle finance. Given the increasing risks in the environment, we have been more prudent in granting loans and have slowed growth in some key lending products. As a result, market share has declined slightly in unsecured lending, including personal loans and card, but we still aim to grow market share over time. We increased market share in retail overdrafts and household transactional deposits. The former by bringing a new competitive overdraft product to market, and the latter as a result of our strategic focus on and the actions we have implemented over the past year relating to this key deposit category. The home loans market remains competitive, and we still aim to grow market share from here. On the transactional side, the number of retail main bank clients in RBB increased by 2% to over 3 million. This increase was driven by higher levels of client activity and the ongoing digitization of our client base. Our cross-sell ratio in RBB improved from 1.84 to 1.92, driven by strong sales performance from both our digital channels and our staff channels, as shown in the booklet slide. These metrics build on the outcome of the 2021 Consulta survey, where our main bank market share continued to increase steadily. In summary, delivery on all key strategic value unlocks is progressing well. The managed evolution IT build is mostly complete and benefit realization on track. Digital metrics are increasing strongly, as evident in the performance of our RBB business, and client satisfaction levels are improving, with Nedbank ranked the number 2 bank in the SA market on Net Promoter Score. Through SPT 2.0, we have seen green shoots in household transactional deposit gains, and we remain prudent and selective in our lending activities in a more difficult macroeconomic environment. We are also realizing cost efficiency benefits through TOM 2. These strategic unlocks are supporting stronger revenue growth, main banked client gains, and cost optimization. Through our fifth and final strategic value unlock, we focus on creating positive impacts and driving sustainable socio-economic development by delivering on our purpose of using our financial expertise to do good for all our stakeholders. Our contribution to social matters, as viewed through the lens of sustainable development goals, is how we measure delivery of our purpose, and this slide shows various highlights of our progress. On the top row, in the first half of 2022, we provided 363 million rand of financing towards student loans and student accommodation, increased our lending to SMEs to 20 billion rand, and provided 1.6 billion rand towards affordable housing. In the bottom row, we provided 227 million rand of financing towards clean water sanitation, relating to public sector reticulation and sanitation projects. In our own operations, we have been a net zero operational water user since 2018 through our support of the WWF Water Balance Program. In 2022, we welcomed our third intake of more than 1,800 youth employment service participants as we continue to make an impact on the South African youth, their families and communities. To date, over 7,000 previously unemployed youth have participated in Nedbank's YES program, and we remain one of the largest corporate participants and the largest bank. We also continue to improve diversity metrics across the group and have maintained our level 1 triple BEE status for 4 years in a row. We will create positive impacts as we remain committed to our market-leading energy policy and the commitments we have made to ensure that Nedbank has zero exposure to fossil fuel-related activities by 2045, with 100% of lending and investment activity supporting a net zero carbon economy by 2050, while accelerating funding to key sectors such as renewable and embedded energy. In line with this, the total amount of sustainable funding raised by Nedbank to date has increased more than 3.5 times since 2019 to 9.8 billion rand. From a renewable energy finance perspective, at the end of June 22, our total renewable energy financing portfolio was 28 billion rand, representing 3.1% of total loans and advances, with current client limits at 37 billion rand, which we would expect to increase further over time. The closure of the emergency in round 5 of the Renewable Energy Power Producer Program around the third quarter of 2022, active participation in round 6, as well as the financing of clients' embedded energy projects and the launch of our solar financing solutions in RBB will enable us to grow our renewable energy exposures strongly in the coming years. And we believe this represents a multi-year growth opportunity for Nedbank. Lastly, from an ESG perspective, we continue to rank at the top end of our local and global peer group across all major ESG ratings, as shown on the left-hand side of this slide. A few key ESG highlights in the first half of 2022 include the following. Nedbank was ranked first in the Refinitiv Satrix SA Inclusion and Diversity Index, which reflects the progress we have made on matters of diversity, equity, and inclusion. We became a signatory to the UN-backed Principles for Responsible Investment and were named the Top Empowered Company for the Youth Employment Service, as well as Top Empowered Company for Enterprise and Supplier Development. In April 2022, Nedbank shares started trading on A2X markets via secondary listing, offering investors choice. Since listing, the Nedbank share has been a top 10 traded equity on this exchange. On audit matters, we appointed Vuyelwa Sangoni as the lead audit partner for Deloitte. We have made good progress in the process to interview audit firms to replace Deloitte in 2024, in line with our commitment to the mandatory audit firm rotation, and will make a further announcement towards the end of the year. Finally, on the back of the remuneration policy vote of 71.7% and the remuneration implementation vote of 72.9%, both being slightly below the required 75% at the latest AGM, we reached out to shareholders and will continue to engage proactively with the shareholders to enhance our disclosures and ESG practices, including comments or questions related to remuneration. I will now hand over to Mike Davis, our CFO, to take us through the review of the group's financial performance.
Thank you, Mfundo, and good afternoon, everyone. I'm pleased to report that the group delivered an excellent financial performance with strong revenue uplift, driving headline earnings growth of 27% and a higher ROE of 13.6%, enabling an 81% increase in the interim dividend. I will unpack the underlying drivers of these results in the next few slides. As highlighted by Mike, key environmental and strategic drivers had a mixed impact on the group's H1 2022 financial performance. Operating conditions were favourable in Q1, but deteriorated into Q2, while strategic delivery supported our financial outcomes as illustrated on the slide. Importantly, we remain on track in delivering the financial benefits of leveraging our strategic investments and growth drivers. Looking at the key drivers of shareholder value creation, H1 2022 was generally a good period for banks and our shareholders, and our share price performed well on a relative basis. Net asset value per share increased by 8% to just below 210 Rand per share, implying a price-to-book ratio of around 1 times using the share price at 30 June 2022. The group's ROE improved to 13.6%, but is still below our estimated cost of equity, and we are working hard at improving this. And as Mike mentioned earlier, we paid an interim dividend of 783 cents. All of the group's profitability metrics improved, as seen in the strong headline earnings, DHEPS and earnings per share growth, in line with the trading statement we released on the 20th of July. Our credit loss ratio remained flat at 85 basis points. Total coverage remained prudent at 3.31%, and our NIM increased strongly. Our balance sheet remained robust, with strong liquidity and capital positions well above regulatory requirements. Turning to our usual waterfall graph, where we unpack the key drivers of the headline earnings growth, NII increased by 9% and NIR by 13%, combining to produce revenue growth of 11%, which was a key driver of our strong financial performance in the first half of the year. Impairments increased by 3% and expenses by 7%, both below the revenue growth of 11%. Associate income continued to increase strongly off a low base, and I'll unpack the performance of our associate ETI in more detail later. Reflecting on the balance sheet, gross banking advances increased by 7% year-on-year and 4% on average. Noteworthy on the left is the stronger growth in CIB banking advances in the second quarter of 2022, resulting in a 9% year-on-year increase, while average advances rose by 2%. Pipeline opportunities, such as closing various renewable energy transactions that are currently underway, should sustain growth into the second half of 2022. From an RBB perspective, the growth momentum continued as banking advances grew by 6% year-on-year and 7% on average, primarily driven by strong performance in our SME and commercial client segments, as well as secured lending, while being prudent in the unsecured lending categories. On the opposing side of the balance sheet, deposits increased by 8% and reached a key milestone as we exceeded 1 trillion Rand for the first time. Current and savings accounts, along with cash management deposits, increased by only 1% year-on-year. However, within this, current accounts increased by 11%, aligned to our strategic portfolio Tilt 2 objectives. Cash management accounts decreased by 7% as clients invested in increased working capital. Call and term deposits grew by 6% and fixed deposits by 2%. NCDs increased by 39% off a low base as institutional clients had appetite in the first part of the year to invest in high-quality bank paper at higher yields. Foreign funding, although small in relative terms for Nedbank, increased by 8% to match foreign lending requirements. Pleasingly, over the past few years, our reliance on wholesale funding has declined as a result of growing commercial funding. We are also seeing early benefits of household transactional deposit market share gains, as Mfundo showed earlier. Turning to the income statement, NII increased by 9%, driven by a 17 basis point increase in the net interest margin. The increase in NII was driven by an 11 basis point endowment benefit from higher interest rates and a 4 basis point endowment benefit from higher transactional deposits and capital levels. For Nedbank, we are positively positioned for a rising interest rate cycle, as NII benefits by approximately 1.6 billion rand for each 100 basis point increase in interest rates over a 12-month period. Liability mix and pricing added 9 basis points, while asset mix and pricing added a further 3 basis points. The increase in NIM was, however, offset by the dilutive impact of the foreign currency loan portfolio, with lower yielding assets that moved into the banking book, previously held in the trading book, in line with regulatory developments. NII growth was 13% or 7% excluding the impact of macro fair value hedge accounting. The key drivers include commission and fees increased by 5%, driven by improved client transactional activity in RBB, growth in main bank clients, and increased levels of cross-sell. In CRB, client activity remained subdued, although the cluster recorded 11 primary client wins that will support growth into the future. Trading income decreased by 10% as unfavorable conditions impact the debt and interest rate markets, partially offset by positive outcomes in the foreign exchange and equity markets. Insurance income increased by 13%, driven by the benefit of lower death and funeral claims in the life portfolio, partially offset by accounting for insurance claims net of reinsurance relating to the KwaZulu-Natal floods in April this year, and the base impact of benefiting from the implementation of a revised asset and liability matching strategy in the insurance business in H1 2021. Equity revaluations doubled off a low base and were driven by realized gains and higher dividends. Fair value unrealized losses from accounting mismatches in our macro fair value hedge accounting solution improved from a loss of 611 million rand in H1 2021 to a profit of 18 million rand this year, after the successful implementation of model methodology enhancements. And lastly, other NIR was largely driven by unrealized foreign currency gains on US dollar funds in our Zimbabwean entity, as the Zim dollar weakened relative to the US dollar and as a result of hyperinflation effects that are also reflected in the net monetary loss line. Turning to impairments, the 3% increase in the impairment charge to 3.4 billion rand was driven by a 4% increase in average gross loans and advances, an increase in stage 3 impairments as we provided for specific CRB counters, including those in the public domain in the aviation and agricultural sectors, and the impact of the regulatory withdrawal of D3 loan classifications. These were partially offset by a general improvement in stage 2 impairments, driven by a decrease in COVID-19 and macro-related judgmental overlays. These overlays reduced from 1.5 billion rand to 900 million rand since December 2021, as 200 million rand was released into our IFRS models and 400 million rand was released through the income statement as these expected risks did not emerge. The group's central provision reduced by 50 million rand since December 2021, with 450 million rand remaining in place to account for forward-looking information and risks not yet reflected in the data and impairment models, including the risks associated with a more difficult than expected macroeconomic environment. Our group credit loss ratio remained flat year on year at 85 basis points, within our through-the-cycle target range of 60 to 100 basis points, and at the lower end of the full year 2022 guidance range of between 80 and 100 basis points that we provided in March. The CIB credit loss ratio at 20 basis points is below the 38 basis points reported in the prior year, and within the cluster's through-the-cycle target range of 15 to 45 basis points, with our commercial property finance portfolio continuing to perform well and reporting a credit loss ratio of 13 basis points, down from the 46 basis points in the prior year. The credit loss ratio in our RBB business increased to 152 basis points and is now in the middle of its through-the-cycle target range of 120 to 175 basis points, up from the 122 basis points in the prior year. Normalizing for the once-off benefits in half 1 2021, the credit loss ratio remained around similar levels. Wealth reported a credit loss ratio of minus 37 basis points, driven by the release of client-specific overlays, while the Nedbank Africa region's credit loss ratio of 110 basis points was within its through-the-cycle target range of 85 to 120 basis points. The group's balance sheet's expected credit loss, or ECL, increased slightly to 26.8 billion from 26.6 billion in December 2021. This increase was driven by the 3.4 billion rand impairment charge and also accounts for post-write-off recoveries that increased to 800 million rand. Write-offs remain conservative and increased from 3.9 billion rand to 4.6 billion rand. From a coverage perspective, total ECL coverage remained high at 3.31%, broadly similar to December 2021 at 3.32%, but much higher than the pre-COVID-19 levels of around 2.2%. Stage 1 loans increased as the book grew and as Stage 2 loans cured and moved back into Stage 1, while Stage 3 loans remained elevated. Coverage ratios across Stage 1, 2 and 3 remain significantly higher than the levels before COVID-19, as seen in the green lines, pointing to Nedbank being in a significantly more conservative position. Our Stage 1 coverage ratio decreased slightly from 0.64% to 0.69% in December 2021, while Stage 2 coverage increased to 7.3%, primarily as a result of loans with lower coverage moving into Stage 1. Performing coverage, which is a combination of Stage 1 and 2, declined from 1.5% at December 2021 to 1.3% in June 2022, an indication of an improving performing book. The Stage 3 coverage ratio remained at similar levels at 38.4%. Shifting our focus to costs, expenses increased by 7%, primarily impacted by an increase in variable incentives that are aligned to improving profitability metrics. Excluding incentives, expenses increased by 5%, reflecting a solid operating performance in a higher inflationary environment. Staff salaries and wages increased by 3%, reflecting the impacts of an average annual salary increase of 4.6%, and partially offset by a decline in headcount of 4%, largely through natural attrition. Other staff costs increased due to lower returns from employee benefit-related assets as underlying returns on financial markets deteriorated, and a higher IT staff development cost, not capitalized and therefore expensed. Computer processing costs increased by 5%, and importantly, as our managed evolution technology strategy reaches material completion, the rate of growth in amortization charge has started to slow. The benefits from lower depreciation and computer processing charges also assisted, specifically as we increasingly leverage cloud-based solutions. Other costs were up 1%, reflecting the good management of discretionary spend. Although we have seen some normalization in expenses such as marketing and travel, this was offset by declines in areas such as accommodation. Associate income from our investment in ETI increased by 74% to 470 million rand, and our carrying value increased slightly to 2.4 billion rand. ETI's most recent financial performance reflects good strategic and financial progress, and we are encouraged by further improvements as evident in ETI's half-one results that were released on the 25th of July. The ETI Group continues to benefit from its strong position in West and Central Africa, where ROEs in the regions were all above 20%. Our gross return on the original cost of the investment increased to 15.1%, as we target more than 20%. With respect to capital, the Group's CET1 ratio increased from 12.8% reported in December 2021 to 13.5%, driven by strong organic earnings growth and a slight reduction in RWA due to a decrease in credit risk as asset growth slowed in some portfolios, and a decrease in market risk as a result of general risk reduction across the trading portfolio. The CET1 ratio is above the top end of the Group's board-approved target range of 11 to 12% and well above the SARB minimum requirement of 8.5%, supporting the strong growth in the interim dividend as mentioned before. With regards to capital allocation, average surplus capital held at the centre increased from 4 billion rand to 11 billion rand, when measured against the midpoint of the board-approved target range, and was driven by the Group's stronger levels of profitability and lower RWA growth. The Group allocates capital to clusters at the higher of economic or regulatory capital requirements, and in half-one 2022, the capital multipliers for economic and regulatory capital allocations were revised upwards in line with regulatory minimums and new board targets. Going forward, we will continue with active capital management while remaining conservative in a difficult, uncertain and volatile environment. We will retain appropriate levels of capital for growth, pay dividends as appropriately guided by our board-approved dividend cover range of 1.75 times to 2.25 times, likely towards the lower end, and from time to time consider other capital management actions. Turning to an overview of the financial performance of our four business clusters, CIB grew earnings by 10% and increased its ROE to 17.9% above the Group's cost of equity. NII increased by 10%, with NIM up by 17 basis points, benefiting from the optimization of exposures and returns in a rising interest rate cycle. Impairments declined by 47%, with the credit loss ratio at 20 basis points at the lower end of its through-the-cycle target range, driven by a decrease in Stage 2 loans, overlay releases, and a more stable corporate environment. The commercial property finance portfolio, as mentioned earlier, continues to perform well. NIR decreased by 1%, mainly driven by the 13% decline in trading revenue I unpacked earlier. RBB increased headline earnings by 9%, and the cluster delivered an ROE of 15.1%, also now above the Group's cost of equity. RBB's performance was driven by strong revenue growth and cost optimization, partially offset by a normalization of impairments. NII grew by 10% due to continued advances growth momentum and endowment benefits from higher interest rates. Impairments increased by 32%, with the credit loss ratio at 152 basis points, driven largely by once-off base effects in half-one 2021 of 529 million rand, relating to the curing of D7 accounts and release of COVID-19 related overlays. Adjusting for these once-off benefits in the base, the credit loss ratio was up by 2 basis points year on year. NIR increased by 9%, reflecting a strong recovery in client transactional activity, as well as benefits of cross-sell, main bank client gains, and growth in card interchange revenue. Expenses growth of 4% was enabled by ongoing cost optimization and digitization impacts. Nedbank Wealth increased headline earnings by 1%, and its ROE at 21.7% is well above the group's cost of equity. Insurance results were adversely impacted by significant insurance claims resulting from the recent floods in KwaZulu-Natal, reduced investment returns due to negative market performance, partially offset by lower claims in the life portfolio. Asset management earnings were flat. Actual assets under management reduced due to negative market performance, with average assets under management remaining steady, resulting in flat NIR. Wealth management headline earnings was up more than 100%, benefiting from credit impairment recoveries, higher local and international interest rates, and an increase in brokerage and estate fees. Headline earnings in Nedbank Africa regions increased by more than 100% to 574 million, and ROE increased to 15.9%, driven by an improving performance in the SADC operations, albeit off a low base, and a strong performance from ETI. In SADC, headline earnings increased to 190 million rand, driven by increases of 12% in NII and 79% in NIR, as a result of increased transactional volumes and higher forex gains in Zimbabwe, although this was offset in the net monetary loss. Impairments increased by 18%, and the credit loss ratio increased to 110 basis points. Improving the ROE in our SADC businesses is a key focus, as it remains low at 6.1% and below the group's cost of equity. Headline earnings in our associate investment ETI was up more than 100% to 384 million rand, translating into a gross return on the original cost of the investment of 15.1%, as I mentioned earlier. The ongoing strategic progress at ETI is encouraging. ETI's recent results showed improved capital and liquidity metrics, with a total capital adequacy ratio at 14.8% at March 2022, and a return on tangible equity of 19.5% as at June 2022. Thank you. I will now hand back to Mike as he covers the outlook and makes some closing remarks.
Thank you, Mike. In closing, I will provide our outlook for the rest of the year and reflect on the progress we have made towards meeting our medium-term targets to 2023, with a key takeout being that we remain on track to meet our year-end 2023 targets, with the DHEPS target still expected to be delivered by the end of this year, in other words 2022, a year earlier than we expected when we set these targets. Starting with our current macroeconomic outlook from the Nedbank Group Economic Unit, that informs both our guidance and our targets. We currently forecast SA GDP to expand by around 1.8% this year, with GDP for 2023 and 2024 expected to grow by only 1.5% and 1.6% respectively. Evidence of the binding constraint that electricity supply in particular and slow progress on structural economic reform in general have on economic growth. Inflation has proved very hard for anyone globally to forecast accurately, and is currently expected to peak in South Africa in July before gradually easing as oil, food and other imported prices moderate and global supply chain constraints ease, alongside expected reductions in aggregate demand from rising interest rates. Our forecast for average CPI is 6.8% in 2022, up from the 4.6% we expected in February this year. Thereafter, we currently expect inflation to moderate to an average of 5.5% in 2023 and 4.6% in 2024. Given the acceleration of inflation and upside risk to the outlook, the Monetary Policy Committee is likely to tighten interest rates further. Our current forecast is for the repo rate to end this year at 6.25%, taking the prime lending rate up to 9.75% at year end, representing a further increase of 75 basis points from current levels this year. Beyond that, we expect increases totaling a further 75 basis points in 2023. The risk of bad debts is expected to increase moderately as interest rates rise, given stronger consumer balance sheets, historically slower advances growth, as well as the high levels of balance sheet provisioning that are currently in place. Industry-level credit growth in wholesale is expected to benefit from increased activity in the renewable energy sector and the gradual uptick in general fixed investment activity. And overall credit growth is forecast to be at or around 5% over the next few years. South Africa's fiscal position remains challenging, reflected in below investment-grade credit ratings, but it has been better than expected over the past 12 months, as the country has benefited from a strong commodity cycle, and this has been reflected in more positive outlooks from the various rating agencies. Turning now to our usual format of shorter-term guidance for the remainder of the full year in 2022. And here, there are slight updates at the half-year stage from the initial guidance that we gave earlier in the year, and I will comment on each of these. For net interest income, after growing 9% in the first half, we now expect full-year growth to improve from our initial guidance of upper single-digit growth to low double-digit growth, reflecting the benefits to the net interest margin of the quicker-than-expected pace of interest rate increases to date and a further expected 75 basis points of interest rate rises. We also expect net NII growth to be supported by ongoing momentum in RBB lending and a mild recovery in CIB lending growth. Our credit loss ratio, which was 85 basis points in the first half, is still expected to remain in the top half of our through-the-cycle target range of 60 to 100 basis points over the full year. That is somewhere between 80 to 100 basis points, and we remain conservatively provided. There is no change in this guidance at the interim stage. For non-interest revenue, after growing 13% in total in H1, or 7% excluding the macro fair value hedge accounting movements, there is no change to our guidance of upper single-digit growth in non-interest revenue for the full year. Expenses, as always, will remain tightly under control, but are now expected to grow above mid-single digits with some upside risk emerging, revising this guidance up slightly from above mid-single digits, primarily as some costs such as marketing and travel should return more strongly in the second half, the introduction of new regulatory costs such as Twin Peaks, and the higher risk of increased inflationary and other FX-related cost pressures. These will be partially offset by ongoing cost savings initiatives such as TOM2. As a result of this updated guidance taken together, we would still expect diluted headline earnings per share growth in 2022 to remain above nominal GDP plus 5%, with growth in the second half expected to be slower than the growth we reported in the first half. Capital levels are expected to remain very strong and well above the top end of our board-approved target range. Lastly, dividend growth is expected to remain higher than HEPS growth, as subject to board approval, dividends are currently expected to be declared towards the lower end of our target range of 1.75 to 2.25 times covered, supported by our very strong capital ratios. This is an update within the range of guidance previously given for dividend cover. Shifting to look further out than 2022, our medium-term targets that we set for end 2023 relating to DHEPS ROE, cost to income and net promoter score remain unchanged, and meeting them should support ongoing shareholder value creation. Given the strong financial performance in H1 and good progress on strategic and operational delivery, we still believe that our 2023 DHEPS target of above 25.65 Rand per share should be achieved a year earlier, that is, by the end of 2022, with our H1 performance representing 52% of this full-year DHEPS target. Achieving our end 2023 targets of an ROE above 15%, a cost-to-income ratio of less than 54%, and a net promoter score with a number 1 ranking remain stretching targets, but following a strong H1 outcome, confidence in meeting them has increased. Beyond 2023 and in the longer term, through ongoing delivery of our strategy, we see further opportunity to increase our ROE to above 18% and reduce our cost-to-income ratio to below 50%, while sustainably growing DHEPS at 5% above nominal GDP per annum. In closing, notwithstanding a complex and difficult economic environment, I am pleased that the Group's good strategic delivery and the resultant strong H1 2022 financial performance position Nedbank well for delivery of both our 2023 and long-term targets, and as a result, ongoing value creation for our shareholders. Our balance sheet remains very strong, with key balance sheet ratios on capital, liquidity and coverage all at or above the top end of targets and well above pre-crisis levels, supporting growth in dividends. The good start to the year in H1, with headline earnings up 27%, revenue growth of 11%, the efficiency ratio improving to 56.2%, the credit loss ratio stable at 85 basis points, and the interim dividend per share up 81%, all support meeting our 2022 financial guidance as set out earlier. All our cluster return on equities are now above the group cost of equity, and we have increased the surplus average capital in the centre from around 4 billion to around 11 billion, a very pleasing outcome in the volatile external environment and a strong underpin for future growth and dividends. We have tangible proof points around strategic delivery, with our managed evolution IT build nearing completion with very little risk of cost overrun, strong digital growth, client satisfaction metrics that are increasing, TOM2 savings ahead of target, and some SPT 2.0 benefits becoming more evident, as well as a market-leading position on ESG delivery, all of which I believe positions Nedbank well for delivery of our targets in both the short and the longer term. Thank you, and may you and your loved ones stay healthy and safe.